Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to the FedLife podcast. I am your host, Dan Sipe. One of these times there might be a guest host, but not yet. You're still stuck with me one more time. Additionally, I'm the branch manager here at Sipe and Ed Zurndorfer and Serving Those Who Serve. I begin, as I always do, to say thank you for taking the time to listen to us, and above all, thank you for your service. You feds are holding everything together all over the country right now, working through COVID restrictions and everything else to keep the machine running, and we are very grateful for that. You do not hear it enough. You will always hear it here. Ed Zurndorfer, of course, is back with us again. The guru is here as part of our ongoing mission to reach, teach, and serve you. Here's the thing I have to say every time. At the outset, I need to say the opinions of our guest Ed Zurndorfer are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you do not have personal advisors, hit up our website, scwserve.com. As we like to do, we are following Ed's FedZone articles, and we are staying in the tax tip vein. And one of the things, and Ed is the only guy putting this stuff out there, wherever you go on any other sites that purport to do this stuff, you're just not going to find, the gold that he's putting into this. And always remember, we archive this. The site is searchable, so you can come back to it over and over again. So this one is kind of interesting to me because this is just the way Ed thinks and looks out for you all. He said, you know what? There were some things that happened in 2020 as a result of COVID. And when people get their 1099-R form, they might expect to see things and they're not going to see them. Okay? So, Ed, let's kick off with the basics because I know you've got some real meat to go into here. What is a 1099-R?
A 1099-R is a statement you receive from your IRA custodian or your qualified retirement plan custodian, including the TSP. R stands for retirement. So what is reported on a 1099-R is it reports a distribution from a pension or an annuity, a retirement, a profit-sharing plan, an IRA, an insurance contract. We're talking about a lot of things here, but they all have to do with, in terms of money that generally people have for retirement. Distributions, money that they got out of their pensions and IRAs or insurance annuities.
Gotcha.
R, just think of R as retirement. It reports distributions taken from these retirement plans and IRAs, insurance plans, in this case during 2020.
Okay. So what is likely to be different this year?
I have to
where to
level
begin?
with you, Dan. I have to level with you, Dan. This has been a very challenging tax preparation season. As you know, I'm also an accountant, and I prepare taxes. And I have received emails, phone calls from individuals who said, I normally do my taxes, but I'm really stuck now. I don't know what to do. And a few of these individuals had received a 1099-R form from the TSP, their savings plan. They're retired feds, or maybe they're not retired feds, but they worked in private industry and they took money out of their IRAs. They had to take money out of their IRAs, in particular required minimum distributions, RMDs. Sure. Just like the people who retired feds who were over 70 and a half had to take RMDs from their thrift savings plan account under the IRS rules because they're over 70 and a half. So here's why they're calling me. They said, in 2020, one of the provisions of the CARES Act is that Anybody who's required to take an RMD this year does not have to take it. They're not required to take an RMD this year because it's just a bad time year. The value of their accounts have gone down because of the stock market went down last March so much.
Sure.
So after the market went down last March, the CARES Act was passed, and one of the provisions of the CARES Act was the fact that this year anybody who is required to take an RMD, anybody, that would include a retired Fed who is getting a RMD, who has to take an RMD from the TSP or a traditional IRA, somebody who works in private industry, who had worked in private industry from their 401k plan, even someone who has to take money out, has to take an RMD from their inherited IRA. So we're going to concentrate on those individuals who are retired Feds who are required to take an RMD, maybe a traditional IRA also if they have a traditional IRA, and they're over because they were over 70 and a half in 2020. So Congress passed this CARES Act in March of 2020, and they decided, Congress, one of the provisions of the law, Congress said you do not have to take your RMD this year. The problem is that several of these federal annuitants had already taken their RMD for the year. They took it early in 2020 before the CARES Act was passed. So what could they do? When you take money out of the TSP, when you take money out of an RRA, you can't put it back. It's out. So IRS put out a notice in April of 2020 that if you already had taken your RMD, we will allow you to roll it back into your account. We will allow you to roll the money back into your account. And in so doing, you won't have to pay tax when the money took it out because you put it back. You have to roll the money back before August 31st, 2020.
Yep, I remember.
Okay, you remember that?
Oh, I do.
And a lot of Feds did that. A lot of federal annuitants did that. So, what's the problem? So, come this past January 2021, federal, these TSP annuitants, I call them Fed annuitants who are retired from Fed service, who had taken money out of their TSP, the RMD, got their 1099-R, and on a 1099-R, it reports in Box 1 the gross distribution that was paid out during the previous year. Box 2 reports the taxable distribution, and for the TSP, the traditional TSP, that's one of the same, because any money coming out of the traditional TSP is all taxable, federal taxable and state taxable.
Yep.
I just want to mention one other box on a 1099-R. Box 7. There's a code in there. There's a certain code. Code 7 means normal distribution. Code G means rollover. Rollover. That is, the money was rolled over to something else. It could have been rolled over to an IRA, and if it was directly rolled over, that means that the distribution, the gross distribution, is not taxable. In this case here, this individual rolled their money back into their TSP account by the deadline, August 31st, 2020.
Yeah.
You would think that when they got their 1099-R, it shows the gross distribution, the taxable distribution would be 0, and in Box 7, it would have a code G for rollover.
You would expect that.
No such luck.
Oops.
One individual he contacted me. He said he's always done his taxes every year. He was a retired auditor at GAO. He knew his stuff.
Oh, yeah.
He always did his taxes, never had a problem. And now he's floored because his 1099-R from TSP showed gross distribution. I think it was, he told me $35,000, and the taxable distribution $35,000 with a code 7 in box 7.
Normal distribution.
He said, "How do I handle this?" I said, "Sir, I hate to tell you this, you're going to need a professional because TurboTax is not going to help you here.
Nope.
You need a professional." He said, "Are you a professional?" I said, "I'd like to think so." Okay. TurboTax is not going to have the software
to
help you through this.
Sure.
Okay. So to make a long story short, there is a special form you need that IRS had to develop a new form. It's form 8915-E. It's a special form to report this rollover.
So is that E for Ed, meaning they need you?
I don't know. They never contacted me. If they did it, they didn't get my permission to use that. You know, there used to be a form 1040-EZ. That was named for me. I like to make things easy. Okay.
I knew that.
So
I knew that.
To make a long story short, he came to me to have his taxes done in the middle of February. I said, I won't be able to do your taxes because the IRS is still working on this form 8915-E.
Gotcha.
They're still working on it. They finally got it done at the end of February. I was able to do his taxes, and after I put everything in program that I needed to do, this is my professional tax program, the gross distribution was the full, I think it was like $40,000, $35,000, and the taxable distribution, $0, because it had in bold letters on the Form 1040 the word rollover. This is what the software developed. Rollover. And when I told him about this, he was so elated that I was able to take care of his taxes this year.
You were the bringer of good news.
I'd like to be the bearer of good news.
Yep.
But I have to tell you that any Fed who did in fact roll the money back, whether it was from an IRA or a qualified retirement plan with a TSP, or into if they had an inherited IRA, they put the money back. You really, really have to go to a professional to get your taxes done this year. It's very, very complex. I don't think the ordinary person can really do this.
Makes sense to me. Now, also up next in your article, you indicated there's some tax breaks related to coronavirus-related IRA and TSP distributions, but you indicate the coding might not be as expected there either?
This is another challenge.
It's always bad, folks, it's always bad when the first part of Ed's answer is a chuckle. I'm just letting you know that. So go ahead, Ed.
I mean, I love challenges, don't get me wrong. I mean, life would be so dull if there were no challenges. But this one is really a super challenge. Let's go back to the CARES Act. One of the provisions of the CARES Act was that individuals were allowed to take money out of their qualified retirement plans, including the TSP. They were able to take money out of their IRAs, penalty-free, no matter what their age was, if they had some type of coronavirus-related issue. Now, thank God, those feds did not have, I say a coronavirus-related issue, we're talking about people who lost their job.
Absolutely.
Maybe they had a family member who lost their job. Maybe they had a family member who came down with corona, and the federal employee had to stay home, take care of the kids.
Gotcha.
There were several categories of individuals who would qualify for these corona-related. It's called CoronaRelated Distributions, CRDs. The good news is that the money, the distributions were penalty free, and they could take up to $100,000 from their IRAs and TSP or qualified retirement plans. So
Sure.
that was sort of a good news. Okay? Again, these individuals who took money out of their IRAs and qualified retirement plans and TSP received a 1099-R.
Yeah.
1099-R showing the gross distribution and the taxable distribution will be the same in the same amount as the gross distribution, and code 7 in box number 7, meaning a normal distribution. Meaning what? The person will have to pay tax on the whole thing.
Yep.
The whole thing. So what do?
I'll bet there's a new form.
Actually, it's the same form.
Same form. Oh, good.
8915-E.
You like it?
I can give you the title of that form. It's called Qualified 2020 Disaster Retirement Plan Distributions and Repayments.
Got it.
And repayments. That's 89-15-E. That form would need to be used because one of the provisions of the CRDs is that if you repay your CRD, if you repay your corona-related distribution, then you won't have to pay tax on the money you took out if you fully repay it.
Well, that's a great segue, Ed, because your next article is Understanding Coronavirus-Related Distribution Income Inclusion and Repayment Options. So perfect timing.
Yes, another challenge, Dan. Another challenge.
You're getting a lot of them this year. You're staying sharp.
Oh, this has been a whale of a tax season. Let me tell you. All right, so here are the options which you can do with your CRD. If you took a CRD, you don't have to repay it back. And yes, you can include it in income. But one of the options for including in income, you don't have to include the whole thing, the whole amount of money you took out, your whole CRD in 2020. You can spread the amount of your CRD over 3 years. In other words, put 1/3 of the CRD that you received in 2020 income. You put the next 1/3 in 2021 income, and you can put the other 1/3 in 2022. This way, you spread out the amount of income, and this way, hopefully, you'll not be pushed into a higher marginal tax bracket with this additional income for each of these years. Because if you include it all in 2020, there's a good chance it could push you into a higher marginal tax bracket.
Sure.
Now the question is, do you really want to include it all in 2020? There are some people it may make sense. To include all of your CRD in 2020 income. Let me give you an example. Let's say there's a Fed out there who was married to someone who unfortunately lost their job. Say a Fed was married to an airline employee.
Sure.
Airlines had a terrible year in 2020, Dan. You know. Sure. They weren't doing much business.
Oh, I do know.
And they were laid off. A lot of employees were laid off. So here we have a Fed who's married to a airline employee who was making, before COVID hit, was making, let's say, $100,000 a year, $100,000 a year, and they lost their job. So what did they make in 2020? Maybe $20,000,
or depending on when it happened. Yeah.
So their income, the couple's income, went down significantly in 2020. Went down significantly. So they're going to be in a lower marginal tax bracket. If they add back let's say the Fed took $100,000 out of his or her TSP account as a CRD to make up for the loss of income. that $100,000 is going to basically just replace the salary of what the person, the airline employee, was earning. Therefore, it won't be much of a tax jolt, so to speak, by including the CRD back in income. It's like dollar for dollar.
Makes sense.
So that may be a consideration. It may be a consideration.
Got it.
If they include the income for 2020.
And they can also pay it back, right, Ed?
And there's another option that you actually can pay it back. Pay it back. The other option is to pay it back. I'll get to is to pay it back. But let me just mention one other thing here about the strategy here. In trying to decide what to do in terms of including in taxable income, because you're allowed you can pay it over 3 years. You can pay it over 3 years. You really need to look ahead to 2021 and 2022, what your income is going to be. Because if your income is expected to go down in 2021 and 2022, for example, we have back to my example. Suppose this federal employee who took out the $100,000 loan is going to retire this year. And the spouse is slowly going back to work. The airlines are opening up. But their income is expected to be much lower in 2021 compared to 2020 because the employee retired. And the airline employee is just getting back on their feet. It might be better to include the income 1/3 in 2020, 1/3 in 2021, because likely they'll be in a lower marginal tax bracket this year and most probably in 2022. It really pays to get some professional tax advice on this to figure out what is the best strategy if you're going to include it in income. What is the best strategy? It all depends on the facts and circumstance. Now, in terms of paying it back, you have two options for paying it back. Okay, one option is to paying it back the full amount.
Gotcha.
And you have up to 3 years to pay it back. You have up to 3 years actually to pay it back. Now, what is that 3-year period? It starts the day after you took out your CRD. 2020. It starts on the day after you took out your CRD. Now, CRDs were only available between the day that the CARES Act took effect and December 31st, 2020. So if you took out a CRD, let's say on May 1st, 2020, your 3-year period ends on April 30th, 2023.
Got it.
You can pay it back over those 3 years. If you choose the 1 year, if you choose to pay it back in 1 year, fine. Say if you decided to pay it back this year. I'm sorry. During 2020, after you took out the loan, you started paying it back. And again, in my example, the person started paying it back right away. They took out their CRD on May 1st, 2020. So they paid it all back by April the 30th, 2021.
Got it.
They paid it all back by the time we just said the tax filing deadline is May 17th. So then there is no tax consequences because they paid back the loan. They paid it. There's going to be no tax consequences for 2020.
Gotcha.
Once again, when you file your 2020 taxes, you're still going to get this 1099-R showing that it's fully taxable, but you need to get a professional to file your taxes using this IRS Form 8915-E to show, in fact, it was paid back, and therefore it's not going to be taxable.
Gotcha.
Okay? Now, if you don't pay it all back, let's say before April, suppose a person doesn't pay it back by
2021
by 1 year, then you're going to have to report. You have to report in income the portion that you did not pay back yet.
Got it.
want to make another suggestion here for a strategy. If you are not sure whether you're going to be able to pay it back in the first year. Okay, so somebody took their CRD on July 1st, 2020,
right.
and they're not sure whether they're going to be able to pay it back all within the first year.
Gotcha.
They might. We just said that the filing deadline for 2020 taxes May 17th.
Yep.
I would suggest if the person is not 100% sure whether they're going to be able to pay the whole thing back by May 17th, they should file for an extension. Extension to file their 2020 taxes to October 15th, because by that time they certainly will know if they paid it all back. It's a suggestion. The question comes up: Do you really want to pay it back? Does somebody really want to pay it back? Is it a good idea to pay back the money you took out of your retirement plan or IRA?
If you're asking Dan Sipe, he says yes.
Absolutely. To think about, the money you took out is no longer going to be getting any earnings, in tax deferred earnings or tax free if you took money out of a Roth account. So yes, it really pays to put it back. So let it keep growing, because you down the line in years from now, that money that you took out is not getting anything. If you left it in there for 10, 20 years, think about the potential growth of that money. It could buy a lot for retirement.
Sure, it is worth the work to pay it back. And folks, if you're working your way through that and you need somebody to talk it through, hit us up at scwserve.com. We'll be happy to sort of walk you through the clear advantages of it, because generally speaking, and Ed, I think you'll back me up on this, there usually aren't loan provisions associated with IRAs, and because of this incredible hit that we all took, there is one. So being able to pay it back is a real advantage. It's
a real advantage, but I just emphasize once again that we talked about the basics here. Anybody who wants to know more about this, please go to the Fed Zone and read these columns, because I have some examples there it'll make it a little easier to understand.
You always do.
The way I write the columns is I try to make it so that the average person can understand it. The examples really help, but this is a real challenge. This is both the RMDs, putting them back, and then the CRDs is a real challenge.
Now, Ed, this year, because I'm sure everybody knows that one of your webinars is a tax webinar, will you be touching on some of this in your tax webinars this year?
A little bit. Okay. I do. We talked earlier about the sale of one's personal residence. I do talk about that during the webinars, and I do talk about the idea of transferring money from the traditional TSP to Roth IRAs. This might be a good time to do that, given the fact that tax rates are low. We talk about different opportunities to improve one's retirement, given the current lower tax rates.
Gotcha.
So I do go into that during the tax planning webinars. Yes.
Sure. Did you like the way I worked that plug in for you?
Love it, and Jennifer and I really go through a lot of discussion, get good questions during the webinars, and we really encourage everyone to take full advantage of not only the tax planning webinar, but the FERS, the CSRS. We have a health insurance, federal employee health insurance, and Medicare webinar coming up. We have Social Security.
Survivor benefits.
We're getting the numbers are up. We get a lot of people who are, and the thing about it is, Dan, there's no limit as far as how many times you can attend.
That is true.
And the more you hear it, the easier it is to understand.
Yep. Jennifer always has to keep explaining to me that these virtual rooms just hold lots of people, because I'm an old guy and I say, okay, we got 150 this week. Will they all fit? And she just pats me on the hand. She goes, yes, Dan, it'll be fine. So on that note, do not miss Ed and Jen Meyer live in the webinars. They are a dynamic duo. And, once again, Ed, nobody does this stuff. Nobody puts this stuff out like you. Nobody builds the examples into into their articles so that regular folks can really get their hands around it. All these things are searchable on our website, folks. If you land there, it's going to look like a lot. We have a lot of content. As a matter of fact, we're working with a firm now that's going to help us curate that a bit better, make it easier to find. So you have, kind of buttons for where to go. So we're always working to do that stuff for you. But you can hit that search bar. You're going to get everything that Ed writes on the topic. So again, Ed, I don't know how you keep it all straight. I don't know how you keep up with the new forms. I'm just glad you do it. I'm glad you do it with us. And I'm glad you do it for the feds. It's a real blessing having you. So, folks, that is, once again, a wrap. We are serving those who serve. Be sure to subscribe to our podcast on our YouTube channel and Spotify. Remember to share it with your friends, strangers, enemies, you name it. Be sure to hit us up on Twitter and LinkedIn. Do not forget those live webinars every week. You may have heard about that recently, in the last 45 seconds. As I said before, just go to the STWS website. That's stwserve.com, and you will see the red webinar button front and center on the landing page. Hit that up. The guru will come to you. You can learn from Ed in your bunny slippers as we work to reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all, share it with your friends. They will thank you. Be sure to read every month in the Fed Zone at blog.stwserve.com and also at fed-zone.com. And for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organization.